Good day, everyone. I am Fatima Nicole A. Canyon, and today I will report the Philippine Accounting Standard 8 or PAS 8 that talks about the accounting policies, changes in accounting estimates, and errors. So, what is the purpose of PAS 8? Accordingly, the Philippine Accounting Standard 8 is applied in selecting and applying accounting policies, accounting for changes in the estimates, and reflecting corrections of prior errors to enhance the relevance, reliability, and comparability of the entity's financial statements. So this simply means that the PAS 8 makes a distinction between how an entity should present and disclose different types of accounting changes in its financial statements. Accounting policies. These are the specific principles, bases, conventions, rules, and practices applied by an entity in preparing and presenting financial statements. That means that accounting policies served as our guide in making financial statements. So now let us proceed with the hierarchy of reporting standards. So first, we have here the PFRSs or the Philippine Financial Reporting Standards. So this standard has three components adopted by the Financial Reporting Standards Council or the FRSC that was the counterpart of the International Accounting Standards Board in UK. So its three components consist of the Philippine Financial Reporting Standards itself, the Philippine Accounting Standards, and the interpretation. However, in the absence of the Philippine Financial Reporting Standard, management uses judgment in developing and applying an accounting policy that results in information that is relevant and reliable. So in making judgments, the management shall consider the following. First is the requirements in other Philippine Financial Reporting Standards dealing with similar transactions. And then secondly is the conceptual framework. The conceptual framework can assist an entity to develop policies when there is no occurring standard. The management may also consider the following. First is the pronouncements issued by other standard setting bodies and the other accounting literatures. So now let us proceed to the scope of the PAS 8. The first one is the changes in accounting policies, then the changes in accounting estimates, and the last one is the correction of prior errors or errors itself. So changes in accounting policies. These are the change in measurement basis. So its accounting treatment may be transitional provision, retrospective application, or prospective application. So the transitional provision from the word transit, it is the movement from old to new. So with that, there are maybe some provisions that would be required in a situation that deals with accounting policies related to the specific entity. So the retrospective application is presented as if the new accounting policy has been applied from the very beginning. If the retrospective application is impracticable, the new accounting policy should be applied in the earliest period where the retrospective application is practicable, which is the current period. However, if the retrospective application is still impracticable to apply in any period, therefore, the entity is allowed to apply the prospective application. It is the application of a new accounting policy to transactions after the date of the policy change, with recognition of the effect of changes in the current and future periods. Thus, the change is not applied to prior periods. So, its effect of adjustment, if accounted retrospectively, is on the beginning balance of retained earnings. So these are the examples of changes in accounting policies. We have here change from first in, first out to the weighted average cost formula for inventories. Change from the cost model to the fair value model of measuring investment property. Change from the cost model to the revaluation model of measuring property, plant, and equipment and intangible assets. Change in business model for classifying financial assets. Change in the method of recognizing revenue from long-term construction contracts. Change to a new policy resulting from the requirement of a new Philippine Financial Reporting Standard, and change in financial reporting framework. So next is the change in accounting estimate. It is an adjustment of the carrying amount of an asset or liability or related expense, resulting from reassessing the expected future benefits and obligations associated with that asset or liability. So its accounting treatment is prospective applications. That means recognizing the effects of the change in profit or loss, either in the period of change or in the period of change and future periods, if both are affected. So these are the examples of changes in accounting estimates. So we have here the change in depreciation method, change in estimated useful life or residual value of a depreciable asset, change in the required balance of allowance for uncollectible accounts or impairment losses, and change in estimated warranty obligations and other provisions. So we are at the last part of the scope for the past 8, which is the errors. Is the intentional or unintentional misapplication of principles, misinterpretation of facts, and mathematical mistakes. So errors may be commission or omission. Error of commission is doing something wrong, while the error of omission is not doing something that is needed to be done. So there are 2 types of error. The first one is the current period error. This error occurs during current period that were discovered either during current period or after current period but before the financial statements were authorized for issue. Next is the prior period errors. These are the errors in one or more prior periods that were only discovered either during the current period or after the current period but before the financial statements were authorized for issue. So its adjustment treatment is retrospective restatement or prospective application. So retrospective restatement is restating the comparative amounts for the prior periods presented in which the error occurred. If the error occurred before the earliest prior period presented, restating the opening balances of assets, liabilities, and equity for the earliest prior period presented. So in other words, it is to correct a prior period error as if the error had never occurred. However, if the retrospective restatement is impracticable, prospective application may happen. Thus, its effect of adjustment is on the beginning balance of retained earnings if accounted retrospectively. So these are the examples of errors: the mathematical mistakes, mistakes in applying accounting policies, oversights or misinterpretation of facts, and fraud. Things to remember: when it is difficult to distinguish a change in accounting policy from a change in accounting estimate, the change is treated as a change in accounting estimate. Also, an entity shall change an accounting policy only if the change is required by the Philippine Financial Reporting Standard or it results to a more relevant and reliable information about an entity's financial position, performance, and cash flows. So that is the Philippine Accounting Standard 8. I hope you have learned something in my report.